In the meantime, what should investors make of today's turn higher? And is this a signal that the worst is now behind us? Let's bring in our market panel. Joining us now is Nancy Davis from Quadratic Capital Management and Andrew Slimman from Morgan Stanley Investment Management. Good afternoon to you both. Andrew, I'm actually going to start with you because we kicked off this week talking about support for the S&P 500 at 4,200. And now we're back to talking about resistance at 4,400 with the average finishing today at 43.14. Is the worst behind us? Do we go higher from here? How do you see it?
Well, it's interesting. When I sent my notes this morning, the market was down, and now it reversed. I thought the rally would start next week because I do think the inflation numbers next week will remind us that inflation is coming down. And then immediately following that, we go into earnings season. And the best earnings season is when expectations are low going in, and that's what we have. And I think it's going to be a pretty good earnings season. So it's a reminder the economy is strong, but inflation improving. I think that makes for a good setup. But as Mike said, and he's absolutely right, the risk is not the level of interest rates. The risk is that the 10-year's gone up, 60, 70 base points in a matter of a month and a half. And that's a big move. And does the risk that something breaks. But going into next week, I think this sell-off has been a great entry point.
Yeah, and I want to stick with that, Nancy, because the 2-10 spread, it's the least inverted in a year. And it's the least inverted because we have seen the 10-year, the yield on the 10-year move as quickly as we have. We've had folks on the air who have said when you start to see a de-inversion of the yield curve, that's actually a recessionary signal. How do you think about it?
Definitely. Historically, Morgan, as you pointed out, as the yield curve uninverts, still inverted, it typically means a recession is coming. And so I think it's definitely the most important thing to be keeping an eye on. But it makes sense to me that the yield curve is uninverting because think about it, with the inverted yield curve, the Fed controls the policy rate, but where we lend money to the U.S. Treasury is the yield curve. And so even with the 10-year where it is right now, it's still lower than the overnight policy rate that the Fed has set. So having a normal upward sloping yield curve is not some tail event. It's just more normal.
Okay. And it's definitely, it's a little more unusual to your point, because this is happening with a bear steepener, not maybe the typical dynamics that we've seen in the past. Andrew, I want to play a soundbite from you, from Marko Kolanovic. Yes, I realize you're competing company, JP Morgan, but have a listen.
You are starting to see the stress in consumer. If you look at the sort of the delinquencies in the cards, in the auto loans, and basically, inflation is there, and rates are higher for longer. So this thing will eventually come, right? And so then we look at sort of upside versus downside, right? And could there be another 5, 6, 7% upside in equities? Of course, right? But if there is a downside, it could be 20% downside, right? And now you compare that to the cash. 5.5%, So now how much equity upside above 5.5%? So maybe 3, 4%, but then downside 20%.
All right. You said you think we're here or poised for a rally through the end of the year. I'd imagine perhaps you disagree with that, but I do wonder if we're higher for longer with the Fed, is there a point at which this actually does begin to extract more pain through earnings and with stocks and on the consumer and on the economy writ large?
Yeah. Yes, you're absolutely right. What Nancy's mentioned, the steepening of the yield curve. Look, the yield curve is steepening because the 10-year is going up. Normally, what happens is re-steepening of the yield curve because the 2-year is plummeting, which is telling you the economy is weakening. So I think, yes, it does suggest a slowdown out there, but I think it's further out. And to Marco's comment, when you get 5.5 on the money market, that's over a 365-day period. I'm talking about a rally in this quarter. So I think you have to be a little bit careful. But I sense, talking to our financial advisors, that clients are very comfortable sitting in money markets. And so I think that cash is still sitting off the sidelines, is not going to get sucked back into the market until ultimately the market is higher or rates are lower.